Joining me for more on this and everything moving markets, or that could potentially move markets today, is Thomas Hayes, Chairman and Managing Member at Great Hill Capital. He joins me at the desk. Thomas, great to have you.
Great to be here, Caroline.
Thanks so much for kicking off this Wednesday with us. So we had a whole bunch of news at the top there. I think it's good to start with maybe PPI and your reaction to that, because obviously CPI yesterday seemed good at the headline level, and then investors sort of dug in and might have seen some tariff impact and things like furniture and clothes. At the wholesale level, it's actually cooler than expected.
Yeah, and wholesale tends to be the leading indicator. You know, if you look at core CPI yesterday, though, it's important to point out, for the fifth consecutive month, it came in lower than estimates. That's number one. Number two, both headline and core were lower than January and February before tariffs kicked in. So the case for rate cuts is starting to become stronger and stronger. And then PPI today, this is surprising, okay, to come in flat, 0.0. So all these people, the Fed included, rather than being data dependent, being prediction dependent, their predictions are proving to be incorrect. And I think there's going to be pressure to really start to consider at least a 25 basis point cut. 63% odds probably went up this morning for September. It should be July. And I do think if it's not July, which the odds are it won't be, we're going to hear who our next Fed chair is going to be next year, and that the market will start to discount a more dovish Fed, even if Powell sits in the seat until next May.
Okay, so would those expectations be incorrect about inflation ticking higher, or have we just not seen the impact of tariffs really hit the inflation data yet? Because we still don't know what overall tariffs are going to be. We have the 10% baseline, but we have threats about even higher tariffs, and some sectoral tariffs that are, already feeling the hit.
Yeah, this is waiting for Godot. I mean, it was supposed to be last month was going to be terrible. This month was going to be terrible. Powell's like, is it going to be terrible? I mean, what's comical about the summary of economic projections is that they, in their own projections, acknowledge it's a one-time bump, okay, which we haven't really seen here. And then at the same time, speaking out of both sides of their mouth, they say real GDP is going to decline to 1.4%. That old dog don't hunt. If inflation's going up, you're not going to see that. So pressure's going to be on, but I think as it relates to the overall market, it's a very unique situation because everything appears to be a little bit frothy, a little bit overbought. We've moved over 25% off the lows in just 3 months. But I've been doing this for 2 decades, and what I found is when you have these V-shaped recoveries, they tend to stay overbought for a while because so many people got flushed at the lows and they have to play catch up. As a matter of fact, since 1950, on average, when you have a 25% move off the bottom in 3 months, 12 months later, the market's up another 22.3%. That's a lot of data, 75 years. So could we get some consolidation? Sure. But I wouldn't get too bearish here because Trump's strategy is he punches people in the face and then he offers them an ice pack and they're grateful. So yes, he escalates. He asks for 300 basis points of cuts. Maybe he gets 100. He asks for 30% or 50% or 100% tariffs. He winds up with 10 or 20, which is more than anyone thought he could get a year ago. And it's proving to be positive. We ran a budget surplus last month. Record tariffs collected, $27 billion. Budget surplus right in line with $27 billion. So then you got tax cuts. We went from bombs and tariffs to tax cuts and growth, and the next phase is going to be deregulation in a massive way for banks, which are going to be able to hold more treasuries with the SLR, supplemental leverage ratio. It's going to bring 10-year yields down. It's going to really kickstart the housing market, which has been left for dead with artificially high rates.
Is that priced in, do you think, at these levels? Because there was expectation for deregulation, but if this is ultimately a market that can push higher, is it just playing catch up, or are there real fundamental reasons that this market should push higher?
Yeah, and I wouldn't be captivated by the general indices because they're overweighted to Mag 7, whose earnings growth has been decelerating all year and is going to continue to decelerate, partially due to CapEx, partially because the rates were high. I think you could see a lot of companies under the surface, the unmagnificent 493, double and triple over the next couple of years without moving the indices much because their weightings are still so low. So this is going to be a really fertile ground for stock pickers doing bottom-up fundamental analysis that know what they own to make an incredible amount of money in a relatively reasonable amount of time.
So if investors have to be a bit more selective in terms of where they're deploying their capital, what's your best advice about where they should be doing just that?
Well, I think the housing theme that's been left for dead is a place to start to look. We've got a couple turnarounds for you, but we own companies like Stanley Black & Decker. They're a derivative play on housing and construction, which is 16.2% of the economy. We have Generac, which owns 75% of the home standby generator market. All of these are highly interest rate sensitive. And then we've got Brad Jacobs' company, QXO, which they bought Beacon Roofing Supply. He's going to do a roll-up in building materials. And you know Brad Jacobs from XPO, which was a 50-60 bagger. You know him from United Rentals, which was also a 50-60 bagger. He makes a lot of money for shareholders, and QXO is just getting started. So those are on the housing theme. We were here with Kristen last month. We talked about a stock called Advanced Auto Parts. Discretionary has gotten left for dead in the first half of the year. It's starting to outperform the second half as the consumer confidence comes back. This is a turnaround play. Shane O'Kelly came from Home Depot Supply. He's cleaned up the balance sheet, sold off the Canada business, paid down debt, shut the unprofitable stores. Now he's back in growth mode. 100 new stores in the next 3 years. The stock has doubled off the lows from last month. It's going to double again over the next couple of years. He's a winner. That's an opportunity. And then we got a couple more turnarounds. Which one do you want to hear first?
Well, we only have 30 seconds.
All right.
So
let me give you a brand new one. National Oil Well Varco, okay? NOV Inc. now they call themselves. Leader in onshore and offshore drilling rigs. This is a way to get exposure to the energy sector. The demand for energy is going to continue to grow massively without taking massive underlying price risk, because we don't know what the price of oil is going to do tomorrow or the next day. 50% install base, and they have a pristine balance sheet, $1.2 billion of cash, only $1.7 billion of debt, $100 billion of free cash flow. They're not diluting shareholders, same share count. So it's a hugely leveraged, operating leverage play on the recovery in rig count over the next 2-3 years. We are going to drill, baby, drill, but we need rates to come down for it to be economic at $60, $70, and they'll be a key beneficiary.
Okay, and looks like you can potentially buy that dip. That one's down 12% year to date. Advanced Auto Parts up more than 30% year to date. We have to leave it there. Thomas Hayes, always appreciate your stock picks and your insights. Thanks so much.
Thanks for having me.
That's Thomas Hayes, Chairman and Managing Member at Great Hill Capital.